There's like this unwritten rule in journalism. You go away on vacation, and boom, news breaks.
President Trump's attempted firing of Federal Reserve Governor.
President Trump has sacked a Federal Reserve governor.
Federal Reserve Governor Lisa Cook is fighting in court to keep her job after the president fired her from the post.
President Trump's attempt to fire Federal Reserve Governor Lisa Cook is unprecedented. Now, Trump's Treasury Secretary Scott Bessent told Reuters this week that the Fed is and should be independent. But Trump is very clear he wants lower interest rates. He's already tried to get Fed Chair Jerome Powell to leave early, and last month he fired the head of the Bureau of Labor Statistics, stoking investor concern about the White House's willingness to Bigfoot into the institutions that underpin the US economy, and therefore the wider world. So on this week's show, we're taking a look from the outside in. How the rest of the world is affected by what's going on inside America's central bank. This is Reuters Econ World. I'm your host, Carmel Crimmins, in Dublin. An independent Fed, one that's free from political interference, is seen as crucial for the US and the global economy. We talked all about it in a previous episode with my colleagues Dan Burns and Howard Schneider. Now we, along with everyone else, are waiting to see what becomes of Cook's legal battle against Trump. But in the meantime, we're going to take a look at the wider world view. To do that, I'm leaning hard on Reuters' in-house expertise. In London, we have Elisa Martinuzzi, who's our editor for financial industry and markets in Europe, the Middle East and Africa. From Frankfurt, we have Francesco Canepa, our senior European economics correspondent, who covers the European Central Bank. And last, but definitely not least, we have Mark Bendeich, our global managing editor for economics, politics and world news. Francesco, Mark, Elisa, thanks so much for joining me.
Thank you, Carmel.
Thank you.
Thank you.
Francesco, if I can start with you, can you set the stage for us and just remind our listeners, why should we care about central bank independence?
If you ask yourself, what has central bank independence done for us? Well, the answer is it has given us lower and more stable inflation for 40 years. Central banks who have become independent have had a lower inflation rate, lower by about 4 percentage points, according to a study in rich countries, and over 10% in poor countries. So essentially, Trump is threatening to rock a boat that has been sailing steadily for 40 years.
Mark, there's clearly a lot at stake here for people all over the world.
Well, I can tell you from personal experience.
Well, go on.
So as the oldest person here, I left school in 83 in Australia. Inflation was 11%, unemployment was 12%. It was a shocking time to go looking for work. And really, it brings it home because we had, in the interim, in the last 30 to 40 years, a huge period of very low interest rates and even disinflation. And it feels a little familiar. So yeah, I think it has real impacts around the world. And particularly now, with the global economy much more interconnected than it was when I left school, I think the implications are even potentially much greater and faster than perhaps they were back then.
Elisa, what are markets making of it all?
If you look at the bond market, you're seeing the pressure at the longer end, that's longer dated bonds, where an array of worries are starting to lead investors to demand higher premiums. They're worrying about inflation getting out of control in the longer term. They're worried about the big debt load that a lot of government Western economies have. And there you are starting to see some of the pricing pressures coming in with yields rising.
We had Ollie Rehn, the ECB Governing Council member, he said that politically motivated attacks on the Fed, he described it as a spiritual spillover to the rest of the world, which sort of as a nice, almost a sort of calming sort of sense to it. But in reality, what it means is if you keep cutting interest rates, it could stoke inflation. It means that ultimately borrowing costs around the world rise and other central banks have to act, right? Yeah. They get sucked into the issues in the US economy. They get sucked into that.
Yeah, there is no way of fully decoupling from the US economy because it's the world's largest and it's also the world's biggest customer, which is also part of the reason why Trump is so upset with this trade deficit. So essentially, the ECB cannot really afford that the Fed loses its own independence, because that would mean globally higher inflation and a difficult question to answer for the ECB. Some observers think it would be a race to the bottom, so the Fed cutting rates and the other central banks following suit so that they don't lose competitiveness through the exchange rate. But it could also be that the ECB would be faced with higher domestic inflation, meaning that it would have to raise rates to be faithful to its own mandate.
So what are central bankers actually saying about all of this? Francesco, you were in Jackson Hole, Wyoming last month, where the world's major central bankers gather every year. What were they saying?
Well, look, despite a cheerful mood, and some central banks even wearing cowboy boots and hats, they were actually worried. Mm-hmm. They were worried that they would too become engulfed in the Fed storm. That's because if the Fed were to yield to Trump's attack, that would set a dangerous example. That would give ideas to other politicians, and particularly to populists elsewhere, to interfere with their own central bank. And what would that mean? Well, policymakers are worried that that would mean the end of 40-year central bank independence, an era that was started when Paul Volcker raised rates to double digits to rein in inflation and repair the damage that had been done by Arthur Burns 10 years earlier when he took the so-called Nixon calls and yielded to Nixon's request to run easy policy. So essentially, central bankers in Jackson Hole were cheering for Powell and hoping he would dig in his heels and resist Trump's pressure, because they know that if he goes, if the Fed yields, they would be next.
It is worth saying, Mark, isn't it, though, that absolute independence for central banks is a bit of a myth, right? We do see central banks working closely with government finance departments in times of crisis and in other times, right?
Yeah, sure. I think that's always a tension. We've seen central banks lose their independence, come under the thumb of particularly strong leaders over the years. For example, President Erdogan in Turkey, for instance, where interest rates were being pushed down as inflation was going up and it hit 85%. But nothing matters in the way the US does, just simply because more than half of all global trade is in USD, almost 2/3 of all global debt is denominated in US dollars. So, yeah, you would expect we'd all have to buckle up if the Fed were to lose its independence.
And as Francesco mentioned, the fear among central bankers is that if Trump succeeds, it will give politicians elsewhere ideas, right?
In this day and age, certainly you could find other central banks coming under a little pressure. I mean, I don't know, I'm speculating here, but the Trump effect hasn't stopped at the borders of the United States. We've seen other politicians emerge. Mm-hmm. The right is on the ascendancy in Europe. I mean, you'd have to look in your crystal ball and look further ahead, but you could imagine a day where other central banks start coming under a lot of pressure and looking across the Atlantic at the experiment that's unfolding in the US. So there are a lot of politicians, to be sure, that want to get their hands on central banks and see them as ivory towers that are essentially out of touch with deindustrialized societies and people who are losing their jobs in manufacturing and all the rest of it. So there is a narrative there. Be interesting to see how it pans out.
Okay, so regular listeners to the show will know that we love a quiz. And this week, we're diving into the history books. Seeing as inflation fears are at the heart of concerns around central bank independence, we thought we'd quiz you on when and where the highest recorded rate of inflation occurred. Was it A, Hungary in 1946, B, Argentina in 1989, or C, Venezuela in 2018? We'll have the answer for you at the end of the show. When we come back, we'll take a deeper look at some of the things that have central bankers worried as the political storm around the Fed intensifies. So right now, investors are pricing in a Fed rate cut this month, so that's pushing down short-term borrowing costs. But long-term borrowing costs are rising, right? Because investors see problems ahead with inflation and potentially with the credibility of the Fed. It's a phenomenon called a steepening yield curve, and it's creating a kind of sugar high for emerging markets. But there is a risk of a serious hangover here, right?
Yeah, I think so. I mean, in the short term, if the US, really has an accommodative policy for a significant period of time, you would expect US demand to pick up. So those emerging markets export to the US and they would benefit from that. And as you say, in terms of their funding costs in US dollars is lower. I think though in the longer term, as the bond market's telling us, that if we see inflation pick up and interest rates respond, then we could get to the point where all this hits the wall.
For anyone holding the US dollar, it's a sort of a worrying time, isn't it? I mean, given what we've seen, the dollar fall since the start of the year, partly on concerns about the future of the US economy and the role of the Fed.
Yes, you're right. But then one asks, if you're not in the dollar and if you're not in treasuries, where do you go? And I think that is certainly a question that, we're asking ourselves over in Europe. And ECB President Christine Lagarde has spoken quite openly about, is this a euro's moment? How do you make the euro a bigger safe asset than it is? And Francesco is far more eloquent than me on this topic, but there does seem to be an opportunity for other assets to gain from the dollar's weakness, but there's quite a lot that needs to be done to get there.
So is it the euro's moment, Francesco?
It's not yet the euro's moment. Even the optimists can't claim it is, in the sense that the euro doesn't have the characteristics that you need to kind of replace the dollar. The euro is backed by 20 different countries, each with their own budget and debt. That makes it inherently fragile. And what we're seeing in France is an example of that. Essentially, France has its budget and problems and debt problems. And the only reason why French bond yields are not blowing out to the upside is because there is an ECB safety net behind it. But that safety net is in turn highly political, because the ECB can only intervene if a country is deemed kind of compliant with the EU budget and economic rules. Mm-hmm. So the euro's architecture is inherently fragile. So there is no European equivalent to the Treasury, to the US government bonds, or to the Treasury as in the institution, which is also why European central bankers know that there is not much they can do if the Fed loses its independence.
Right.
Because the currency in which the world saves, invests, and trades remains the US dollar. So the best they can do is to tell banks, watch your dollar exposure, but they know they won't be able to wind it down completely or to replace that with another currency. To give you some numbers, the world's euro-dollar market, which is the market for bonds and loans issued in dollars outside of the United States, is $25 trillion. Whereas all the dollar-denominated reserves that foreign central banks have are just $7 trillion, which means they couldn't even, if they wanted, cover that with the dollars that they have in their pocket, which is why the Fed is so crucial and the Fed's independence is so important, because you need to be able to know that the Fed is there, that the dollar taps are still open if you need them, and that no precedent can interfere with that.
That's an interesting point, isn't it? Because that is one of the, I suppose, under the kind of headline of worst case scenarios, that is one of the fears for central bankers around the world, that if the Fed does become politicized, it won't be there in times of crisis, as it has been in previous times, opening up those swap lines, offering cheap dollar funding, right?
That is one of the scary thoughts that have been going through central bankers' minds for the past 6 months. What if the Fed becomes politicized, and what if Trump or whoever decides to weaponize these swap lines, which are essentially money taps? They are credit lines that foreign central banks can use to borrow dollars against collateral denominated in their own currency. So essentially, if those taps are turned off, there is no guarantee that commercial banks abroad will be able to get dollars when they need them. Right now they can. A European bank can turn to the ECB, the ECB can turn to the Fed, and that's how the dollar market is always kept liquid and well functioning. But if those taps are turned off for political reasons, perhaps as a means of coercion, in a way that tariffs are sometimes used, well, that would be extremely scary, which is why European supervisors have been telling banks to watch dollar exposure, but they can do little more than watching it, in the sense that you can't wind it down completely, because it's just so crucial. It's the number one currency for saving and investing.
In practice, what can they do if the worst case scenario does emerge and the Fed does become politicized?
The answer is not much. The wackiest thoughts I've heard is that they could pool their dollar reserves and their gold reserves to form some sort of common pool of reserves, of dollar-denominated reserves to use in case of an emergency. But as I mentioned earlier, it would be too small at just $7 trillion. So essentially, there is no emergency plan. There is no way around the fact that the dollar is dominant and has become the lifeblood of global markets.
If you're interested in hearing about the stories behind the news, check out our new podcast, On Assignment. We bring you to the heart of the action behind the headlines. I'll put a link to the latest episode in the description of this show. You can also find it on the Reuters app and Reuters.com. Just click on podcasts and search for On Assignment. We've talked about it's hard to find an alternative to the dollar, but geopolitically, Mark, like US rivals could exploit this. We already have seen Chinese and Russian officials promoting a move away from the dollar. So in other words, there is this moment, there is this opportunity, perhaps, for Beijing and Moscow.
Well, this is a really interesting question, right? They're sort of walking the talk. I mean, we've just seen Prime Minister Modi with Xi Jinping over the weekend. Also talking to Vladimir Putin today. And, the temptation is to watch all of this and think we're actually watching in real time a reordering of the world in terms of the major powers. But look, I think the big caveat to this is that if you want to take on the dollar, you have to acknowledge that that is the big consumer. I think the US consumption, both private and public, is worth more than the EU and China put together.
Right.
So there is only one buyer on the high street. So if you want to really take them on, you've got to consume more yourself, I think. You've got to start become a bigger consumer. China is really struggling to do that. And then there's being an open economy. Obviously, everyone can trade US dollars and treasuries in the blink of an eye.
Yeah.
There's no liquidity risk in the treasury market. Well, not yet. So again, if you want to do that with other government bonds around the world, no matter what they talk up, at the end of the day, you have to get in and out of those markets. You have to be sure. Another place I worked was Malaysia, where they just introduced capital controls overnight on a Sunday night. And this was a big open economy, which relied a lot on exports to the US. And that reverberates down the decades when you do stuff like shut markets, put capital controls on, don't let people trade freely in your securities. So, yeah, I think there's you have to do more than talk if you're China and India, I would have thought.
And I think you're seeing that in those sort of central bank reserve currencies that, hasn't really budged from the dollar. Having said that, I think the data still doesn't perhaps capture the last sort of few months of the year. So it's a little bit from earlier on. But the yuan is still, I forget what the number is, but it's a small fraction of global central bank reserves.
In other words, central banks, they're not getting rid of their dollar reserves. They're sticking with the greenback, despite everything that's happening in DC.
They're buying gold. That's one thing they're doing, buying more gold.
They're buying more gold.
True.
There is another element, isn't there, to foreign central banks' worries about dollar dominance right now, and that's stablecoins. So they're a type of cryptocurrency, and as they grow in popularity, they're expected to boost global demand for the dollar. That does have the ECB worried, right, Francesco?
The ECB fears that US stablecoins may even gain ground in Europe as a means of payment and thereby erode the euro's role on its own domestic turf, which is why the ECB is trying to speed up the approval process of the digital euro. Let's see if that works out, which is going to be its own version of a digital currency. It's essentially going to be a wallet that every Eurozone resident will be able to have at the ECB and guaranteed by the ECB, although it will be probably operated by private sector entity like a bank or a wallet operator like PayPal. And there's also worry that in terms of international transactions, stablecoins will replace bank transfers because they are cheaper and more efficient. So essentially, the ECB is having to rethink the digital euro plan, which have been in place for years, in light of this new threat. They call that strategic autonomy, which means not having to rely on the US. Because right now, European citizens use US credit cards and obviously the SWIFT messaging system, which is also in the hands of the US to make payments. And what happens if in the future it can no longer rely on the US to provide these means of payment?
If you're interested in hearing more about stablecoins, we have a whole episode devoted to the topic. I'll put a link in the description to today's show. Stay tuned to hear what might be next for financial markets as the battle over Fed independence winds its way through the courts. In terms of game planning out where this all goes, we know that as we record this pod, Governor Cook is seeking a court order to block her firing. But this is expected to go all the way to the Supreme Court. At what point, Elisa, could we see markets sort of freak out? Because it seems right now that they're betting that the courts and the Fed itself will prevent the worst case scenario of unbridled political control. But what's the pressure point? Do we know?
Bit of a difficult question to answer. I think in terms of the markets are sort of very much focused on this, where rates are going to go in the short term right now. And, the 25 basis points cut, so the 0.25% cut is very much priced in, whether, Cook is on the panel to vote or not in the coming decision in September. Beyond that, it's a little bit harder to tell. But I think, there could be a confluence of factors that prompt people to sort of start worrying about, both the dollar and treasuries.
There are plenty of opportunities for a wobble, right? I mean, the month of September is traditionally a volatile one for markets.
We've got quite a lot of long-term dated sales of bonds that are coming up. There was actually a weak debt auction last week in the US, and I think those are the moments where you might see some of those pressures coming forth again, and you can't really be sure where they could come from. I mean, it could start somewhere else. You've got Japanese bond yields at records. I mean, you might see pressure actually building elsewhere. And actually, I think that there are some who argue that, higher Japanese bond yields tend to be a harbinger for things to come.
Francesco, from what you know from speaking to your central bank sources, do they have is there a particular pressure point for them?
Well, they don't even want to think about it.
It's their job. That's their job. They have to think about it. To quote Roy Keane, one of my favourite footballers. But yeah.
Well, what I was about to say is that when Powell delivered that dovish speech in Jackson Hole, they all looked the other way. They were all trying to say, well, yes, it was a dovish speech, but he justified opening the door to a rate cut with economic arguments. It didn't seem to yield to political pressure. Well, and the way I put to them is, but he was never going to do that, right?
Yeah.
He was never going to say, I'm going to cut rates because Trump wants to. He was always going to make a credible economic argument. The fact remains that he signaled a rate cut while inflation remains far higher than the Fed's target, and the job market and the unemployment rate is still low, and there is a looming squeeze from lower immigration into the United States. So essentially, it is not the most consensual and logical rate cut by the Fed, if indeed we have one in a couple of weeks. So central bankers don't even want to think about the pressure point, because it would be too painful.
So where does this leave us all? I mean, even if Cook remains on the board, if she wins her court action, has the damage already been done, Mark, do you think, for the Fed? Is there long-lasting damage?
Well, I think it's a bigger question about institutions in the US, I think. So I think if this goes as expected to the Supreme Court, and the Supreme Court has a strong ruling in favour of Fed independence and doesn't allow this, I think that will be a very strong signal that US institutions are alive and well for now. But there may be other options, who knows? The Trump administration has thought through problems like this before. We'll probably see it on the trade front. They got a ruling against them from a DC federal court. So there are other options, for example. So I think we'll see, but I think the thing that's squarely at stake is the independence of this institution.
You raised a valid question, Carmel, if I may interrupt. Yes, I mean, I guess the question is the genie out of the bottle, right? And,
right.
At what point, the fact that the genie's out of the bottle, will it rattle through to markets? And it's unclear yet. The longer term implications might take a little while to feed through, but you're looking at potentially less efficient economy, not just in the way of more volatile and higher inflation, but generally the efficiency of an economy is associated with certain checks and balances, right?
A big thank you to Elisa, Francesco and Mark for their time and their insights. You can find their work on Reuters.com and the Reuters app. As for our quiz, the question was, when and where was the highest recorded rate of inflation? The options were Hungary in 1946, Argentina in 1989, or Venezuela in 2018. And the answer is Hungary in 1946. This is Reuters Econ World. Every week we go deep on the economic principles and ideas driving the biggest news around the world. If you want to tell us what you thought of this week's show, please drop us a line in the comments section of your favourite podcast platform. You can also reach out to me on LinkedIn. Sound design, music composition and engineering on this episode was by Josh Summer and Seb Summer. Our podcast team includes Kim Vanell, Tara Oakes, Gail Issa, Christopher Walljasper, Jonah Green, David Spencer, Abisoye Adelusi and Sharon Reich-Garson. Our executive producer is Leela de Kretzer. Remember, for all your daily news, check out our Reuters World News Show. You can catch it on the Reuters app or wherever you listen to your podcasts.